They're not doing the due diligence. When you're in a startup, you're worried about every dollar. Silence is scary. When people are yelling at you, you have to know when to turn because you are definitely.
Welcome back, investor. We have another episode of Passive Income Adventures today with one of my colleagues that we frequently do business with, Sanjay Vora. He is the co-founder of Ivester, and it's the software platform that Rise Capital uses to administrate our own deals. It's a customizable fund platform so that our investors can come in and say, I like this deal, and I don't like that deal. So you don't have to invest in everything that we're doing. And it allows us to be more flexible and more diversified. And you can custom make your portfolio. So it's a piece of software that has been basically the foundation or the backbone of how we built our fund in a way that allows you to have as much or as little control as you want over the things that you're putting your money into. And so I'm looking forward to this conversation because it gives me a chance to understand a little bit more about where they're coming from, the background, and maybe the direction that the software and the business are moving in the future so that we can better utilize the features to bring to you as an investor. So let's have Sanjay join us and tell us a little bit about himself, what he's got going on. Sandy, tell me your journey from your education, your business world, how you transitioned out of that corporate and into investor, and introduce yourself with your story.
Sure. I'm excited to be on and thank you for inviting me. Again, my name is Sanjay Vora. I'm CEO and co-founder of Ivester, and I'll talk a little bit about the company, but a little bit about my background. I started in tech from the engineering side, then got my MBA, and then joined Intel. So I was with Intel for over 2 decades, worked my way up, did product planning, strategic planning for our PC business, and then did quite a few different things. I became an executive there. And then I ran our partnership with Microsoft on the software side for about 5 years. And then while I was doing that in parallel, I was thinking about, been there a long time. What's my next chapter? Where do I want to go? And in parallel, I was also doing a lot of investing on the side. So I had originally started back in probably about 2012, 2013. Made a decision back then I wanted to really shift my portfolio completely because 100% was in stocks and I felt like there
Okay.
was too much risk. And I wanted to have a little bit of room to go into alternatives and different types of investments. And I started in that space and said, okay, what do I go do? And around that same time was when crowdfunding came around and all the crowdfunding rules started coming. So I'm like, hey, this is a great opportunity. Let me take a bunch of my money and start testing it out in different places. So I started investing through a lot of crowdfunding platforms, all kinds of syndications, deals, real estate debt, equity, all of that. And I did that for about 5 years and really got a feel for what it was like to be a passive investor. And some deals went well and other deals just crashed and burned. But that's how I learned is by doing both of those. And so that kind of after 5 years led me to the idea of, hey, maybe we could do something better, which is it's so easy for an investor to invest in the stock market. You just go open up a brokerage account, you can do research on stocks, and you can just go and start buying things if you want, or you can hire somebody. Either way, but both options are available. But when people think about alternatives or real estate, it gets a lot harder. It's hard to find the investment opportunities. It's hard to find which ones to invest in. It's hard to find people you trust. And so that was what led to the creation of Investor. And we said, hey, why don't we build a platform that really helps passive investors, helps the folks that are actually managing the money, which are sponsors and fund managers, and try to build something that kind of brings everybody together to do it in an easier, simpler way. And that was the formation of the company.
Yeah. So you're talking about, we're all familiar with investing in private equity through like Kickstarter, that
Yeah.
crowdfund, and they got a new product that's going to take over the world and you put in a little money and that's crowdfunding. So everybody gets private equity from that standpoint. I don't know if everybody understands that what they're doing when they do a crowdfund is investing in private equity. Like these are not publicly traded companies. They haven't
Correct.
been vetted by all of the advisory or regulatory boards that make sure that the company that's on a public market. I always joke that's like if a teenager can open an account on Robinhood and invest in it, it's a publicly traded company and it's gone through asset tests and all that. But if you're on, say, a Kickstarter, none of these
Yeah.
claims have been verified. They haven't gone through any of that. Maybe the FCC is don't lie, right? But there hasn't really been any financial due diligence to put that on. So some people are like, oh, I don't know how to get into it. But like you said, these crowdfunding platforms are the thing that is can be publicly shared. So you got Yield Street, Crowd Street, all of those that you're on is that you're investing in public equities and maybe even private credit if there's a fund on there that does say what we do, like hard money lending or something like that. And so people are really familiar with these concepts, but yet I don't think they really realize it should and could be a big chunk of their portfolio. What was the kind of decision that you're like, overexposed in the stock market. I need to do something else. I need to diversify. And how were you led to private equity, basically, private credit?
Yeah, for me, it was just I was looking for all different things, right? So it wasn't just I was just looking to find a lot of different investments that I could and try different things. So I tried the debt platforms because there's quite a few debt ones, and then there was a bunch of new crowdfunding equity platforms, and I just started putting things in there. But you're right in that as a passive investor, you assume that the platform does all the due diligence and it's all safe and all that. And it's actually not the case at all. And that was probably one of the first learnings I got as an investor, which is the platform, it doesn't matter who the platform is, they're not doing the due diligence. You're still responsible for doing due diligence. It's no different than if you go and you pick a stock and you haven't done the research on the stock, you're going to take a risk. Yes, there's more data available, but in a passive investment, you also need to do the same level of research. You have to talk to the sponsor of the deal. You have to go and understand the details of it. And that was probably one of my initial mistakes, which is I
Mm.
took the assumption that the platforms are the ones that are responsible for doing all of that. And generally, they're not. They're the ones that are providing or enabling the investments to be available. And that was a big learning for me. And I lost on a bunch of deals. And so that was how I got smart. I then started creating my own, basically my own underwriting spreadsheets. So when I started looking at debt deals, I would actually go look at each deal. I would look at the metrics on the deal. I'd actually look at the state that the deal was in to see is it investor friendly or not investor friendly. So I started to learn with equity deals. I started building my own risk scoring spreadsheet.
Mm.
So those were the types of things I started doing as an investor because I learned and realized that, hey, you don't want to trust others. You need to do due diligence on anything you're doing. And so that was probably my biggest learning was that it's just like anything else. Make sure you dot the I and cross the T's on anything you're investing in.
Yeah, it's index fund or an ETF. Then you take another level of self-education, more decision making when you start buying individual stocks, if you ever puts and calls, things like that that you can do on public markets. And then you have to think about private markets the same way. Like they're if you're not just going to do this huge basket of diversification like you would in an S&P fund, you
Yeah.
need to do a little bit more upfront and maybe even spend a little bit of money to be able to look at the due diligence and make smart decisions on these. So take me to that moment when you were doing this thing and you were like, why can't we? Because I had a similar experience with the club that we run. Like we have a fund that's a Regulation D fund and it's pretty standard. The only odd thing about it or unusual thing about it is that we have a customizable fund. But I had this investing club, I still have it, where I was very frustrated with the people who wanted to joint venture. He's like, you can only have 5 people and they better have a lot of money. I'm like, what about people who want to be actively involved and they only have 5,000 or $50,000. They have 50 grand, but they don't want to be a limited partner. They want to be a joint venture. And I was talking to my partner who's a securities attorney and I was complaining. I'm like, why can't we just build like an LLC, put a bunch of these people in there for just a little bit of money and they can get some exposure, some decision making, some participation. I just don't understand like why this isn't okay. And he goes, it is okay. It's an investing club and the SEC has already carved out
Yeah.
how those work. I'm like, wait, what? And so that moment, I realized that there were no real estate, commercial real estate investing clubs and started basically building that. And so that people could invest in things in a different way. And so it all came from like a problem and a frustration and a why can't this or why doesn't it work this way? So tell me about that moment with Ivester where you're like, why can't we just blank? And then you thought, maybe I could build that.
Yeah, so it was after about 5 years of doing my own investments. I had probably close to 100 investments, and it was just a nightmare. It was a tax nightmare. It
Yeah,
was a
I'm
nightmare
sure.
logging to everybody's different portals, trying to figure it all out and
Mhm.
finding the data and looking for updates, and it was very messy. And that was the point that I was like, "Wait, why does it have to be this messy? Why does it have to be this hard? Why can't it be as simple as a brokerage?" And so then I started doing my research. I'm like, okay, what if we could go build something like this? Started talking to a lot of securities attorneys, looking at different options and built not even, I wouldn't even call it a very early alpha stage solution and started playing with it and trying it for a little bit. And then it looked like, hey, there might be something viable here. So that was when I got my other co-founder and we came together and we formed the company. And I said, "Hey, I think we got something here." So the way we did it was we launched Aerial Fund, which was it was our own fund, and that became our test vehicle for what is now a customizable fund, and we've got quite a few customers building them. But our first fund was exactly that. So it took a while to find, and even I went through probably about 7 securities attorneys before I found one that was willing to work with me to do what I wanted to do and build this thing, because they were all like, it's impossible. You can't do it. And I'm like, no, there's got to
Yeah.
be a way to go do this. And it's a combination of the way we write up the legal docs as well as the technology stack that supports it, that allows us to go do what we want to do. But the basic concept was, I didn't like blind funds because you don't get to pick and choose, as you don't get transparency. They're very, you throw your money into something and you're hoping it does well. You may or may not have any idea how much is being spent where or what's going on. And so I really didn't like blind funds at all. I refused to invest in them. And then, but I didn't like all the complexity I was dealing with my current portfolio, which was like all these separate investments that were creating just so much complexity for me as an investor, going to so many different places. So that was where the concept came from. And we said, let's go build something better. And came up with the idea, said, let's go do this. And then we started we found the attorney, we got the legal structure in place. Then we started talking to friends and family and said, hey, let's see if we can raise the money. Started raising capital. Then we said, okay, let's now go invest the capital, started evaluating deals, built our own underwriting model, looked at risk factors on deals, and started investing and fractionalizing the investments so the risks were low. And crazy enough, when we started it, we were taking 25 and $50,000 syndications and slicing them up into 5,000. So our value proposition was, hey, you can build a whole portfolio of debt and equity deals for less than $50,000. And that was where we started. And that led to the creation of the first customizable fund. And we did that for 3 years before. And it was after 3 years in parallel, we went through the pains of being a manager ourselves, saying, hey, this is hard to manage all this stuff, building the tools, the capabilities to go do it. And that was the progression to it, where we then got to the point 3 years later where we said, okay, now we've got something here that we could potentially offer customers.
So were you buying your own real estate deals or were you raising capital for other people's deals?
We
Like
were
what
fund of funds.
is okay, so your fund was raising micro fractionalized capital.
We were
Yeah.
finding investment opportunities in debt and in equity, just like any other fund of funds. We were doing due diligence, evaluating and finding good, attractive investment opportunities, then raising the capital for the fund, and then enabling those opportunities and fractionalizing them on our platform.
Okay, yeah, because I remember when we were at a conference, I don't know, maybe a year or so ago, and Badri, your partner, was speaking, and I remember just sitting in the audience and thinking, "Oh, he's actually an investor, like, he knows what he's talking about." Because 'Cause I'd always just thought it was, like, this technical platform, but after listening to him speak about a little bit of the history and what you guys were building and your own frustrations in the marketplace, I thought, "Okay, they're coming at this from their own pain point, and
Yeah,
that we all have, and they have walked the talk. They have passive income that they've built up, successful corporate careers. I don't know if were you looking to exit the rat race and then you're like, "Look, but then I wanna get into the founder world," which is another
I did,
type of
because
rat race, but
I wasn't looking for this specific opportunity, but
Mhm.
I had always had a desire after I got my MBA. At some point, I went into corporate, but then I was like, hey, I definitely want to go do a software startup. But then life happens, you get kids, and then the kids are small, and then you're like, okay, this isn't the time. This isn't the time. And 2 decades happened, and then I
Yeah,
finally got to this point where I'm financially stable. I had a good career, and I was like, okay, what's next? And so I'd spent multiple years looking at, hey, what could be things that we could go do? And I didn't jump right in. I was still at Intel, and then did this on the side, learned did it passively on the side in my free time, and
right.
got my feet wet. And then it wasn't until 2020 or 2021 that I actually left Intel, and I took retirement back then and said, okay, you know what? Now it's time to go full time into this thing. Um,
Yeah. Oh, my husband was an IT guy for several early stage tech startups. And so I would sometimes contract for marketing or I would be in the office like doing an investor lunch and learn, things like this. And getting to know those founders and befriending those founders, I was like, man, I don't ever want to do anything like this. And so what was it that made you want to do that? Because I was preaching the passive income train. You're on the passive income train. And then you're like, let me go take on a massive, more than full-time job. What did that decision process look like for you?
To me, it's always about excitement, right? I always had this dream of, I want to go build a software startup. I don't know why. That was just, I want to build a company. And software is just, you just see the excitement in the industry, right? On all the new things coming out and new
Yeah.
capabilities. And so part of it was just the challenge itself and saying, hey, what's my next big thing that I want to do? And yes, I could have easily jumped to another company in the same industry and gone to another big tech company. But to me, that was like, okay, yep, I did the tech side 20 years plus in the tech world as on the corporate side. I'm like, I want to try something really hands on and challenging. And oh my God, it's more than a challenge to say the least. It's 24/7, 365. There is no downtime, but it is, you have to really look deep and do some soul searching before you get in, because in the corporate world, I had a whole team under me and I had tons of people helping, and I can direct them and say, go do this, go do that, go do this. And things get done and you don't worry about it. And then you move
Mhm.
into this world and it's, oh boy, where do you start? Every single little thing you have to figure out. And it's a completely different world. You-
Yeah. As much help as you hire, as much as you try and systematize and delegate, at the end of the day, it's your company and you could be in there like actually writing code. You could be in there doing customer service, sales, like you're doing little pieces of all of it, even if you have been able to systematize and delegate hire. Does it ever really go away until you become like, I don't know, IBM or have a big merger or something?
I think successful founders are the ones that are super deep. They're not the ones that are high level. And that is probably one of the biggest things that from a transition standpoint, if you're in corporate, you're in a big company like Intel was 100,000 plus people, right? Everybody has their quote roles and responsibilities, and you are in your space and you don't worry about other spaces. Like the engineering guys don't worry about the finances coming together, right?
Yeah.
When you then switch to startup, you're in every one of those spaces.
Yeah.
So you really have to be able to jump between all of those and figure them all out and get comfortable with them all. And even when you hire people, your first person, your second person, your third person, you can never lose sight of the details, because the one thing I think I realized, which is really hard when you're in a big company and that's a multi-billion dollar company, is the money just flows, right? When you're
Mhm.
in a startup, you're worried about every dollar and whether it's going to come in the next day. You worry about every penny that's going out and is it going to be spent properly? And you're into the micro details, where in a big company, you don't worry about those types of things, right? But
Uh,
it's all kind of theoretical, right?
yeah.
But when you're a founder, you're looking at that bank account every day saying, is it going up? Is it going down? What's happening?
Yeah, you're reminding me, is you know my partner very well, Chris Borden, and
Yeah.
he handles the ops side mostly. He's the CEO because I did not want to start a fund and be a fund founder and do what you're talking about, like every finger on every detail. And I didn't start a fund probably 3 years until I found somebody capable of doing that deep work and was like, you be the CEO. I will help you build your business. I will raise capital for your business. And we have really gone over to more of the hard money side versus say we do some multifamily because that's really where I am. But that his experience running that multi-billion dollar corporation, the thing that it reminds me of is when you're very diversified in your own fund. Like, he was in the grocery industry, and so every bottle of ketchup that they sold, they every baby diaper, like, all it was so much stuff that they were selling was very diversified, so they didn't have to worry about that next dollar coming in. They knew that are they at almost 1,000,000,000 or are they just over 1,000,000,000? Like, that was the kind of the things that they were looking at, and so it taught me the lesson, like, a diversified portfolio as a passive investor is really key to stop worrying about, like you said, every dollar, every
Yeah.
penny, because I know that even if it doesn't come in from here, I've got cover. So it goes ebbs and flows, but it never spikes and dips. And that reminded me of how I wish the company was just one little company. But because it's not diversified enough, we're not going to get away from that. And so in my investing portfolio, my own passive portfolio, I become almost like a crazy to be more diversified, to smooth out the irregular income and the uncertainties of things and do things that are super boring and have all spread around. And the nice thing about that is having these technical tools to help me track all of this stuff. And I feel like, how has that corporate experience, passive investor experience, and now founder experience taught you about the importance of diversification versus specialization? So everybody says if you want to get rich, concentrate, but if you want to keep your wealth, you should diversify. How do you balance that in your own life?
Think you have to look at what level of risk you want, and then how much money do you want to put at the different levels of risk, right? You could put 100% of your savings in treasuries and be fine. And if you have zero risk tolerance, you could put 100% of your money in crypto, all the little new cryptos, and you could go do that and be willing to lose it all. Or you can diversify across the stack and say what you want to do. So, first is you have to do a self assessment of yourself and say, how much are you willing to risk? How much are you willing to take? And first decide that factor. Then say, okay, where do I want the money? Do I want 50% in the stock market? Do I want 70% in the stock market? And even inside the stock market, there's obviously low risk, medium risk, high risk, right?
Yeah.
But I think the one thing is the asset class diversification is so important because it gives you a lot of opportunity to really not get impacted by different economic factors. Where one, if the real estate market blows up, maybe the stock market is doing good. If the stock market is crashing, the real estate market might be doing good. Crypto could be its own thing, right? You could be doing loans. There's a lot of different places that you can play the ball. So I think first is understanding at a high level, how do you want your portfolio to be? Now, if you go ask a financial advisor, they'll tell you, oh, 100% in the stock market and bonds and cash and
Too
you're
much
done.
green for it.
But that's
Yeah.
because that's the financial incentives that they're getting to keep it. That is why alternatives are, quote, always 10%. Why? Because they don't want 90% of the money to not be controlled with where alternatives are not
Yeah.
controlled in the same way. You have to look at the underlying intentions of people, but then take a step back and say, what is it right for you as an investor?
Mhm.
I know a lot of people that are 100% in real estate and they're 0% in the stock market.
Well, not a good idea. Too much real asset, not enough paper.
Yeah. Some of it is just easy self reflection and say, "Yeah, how do I want to diversify? What
Right.
areas am I interested in? And you want to invest in things you're interested in because otherwise you just won't have fun. Part of it is you have to enjoy investing.
That's true because there is some amount of tracking that you have to do regardless of what you're invested in, that you can never have everything all on one platform. And so keeping track of things, even though you've simplified it in a lot of ways and some other tools trying to simplify it, there's still like a broader basket. And there are some things that I just don't like checking on. Like I just don't want to read the report. I'm just really not that interested. And so I've had to think, okay, I'm passive in this, but I have to at least be moderately interested in what they're doing because I do have to track my
Yeah, you do have to
portfolio.
track. Yeah,
Yeah,
absolutely. And you have to stay on top of this stuff, right? Because things change. Like with the interest rate hikes that happened, a lot of deals went south and a lot of deals are not doing well. And it's important to understand why that happened so that you, as an investor, don't make that mistake. One of the key things that when we were investing and I learned is you really have to understand if you take real estate as an example, you really have to understand what could cause the real estate to go down. And I think people look at the numbers sometimes on a deal and go, oh, this has got 20% IRR. But what's causing them to get the 20% IRR? It's okay, it's an assumption that they're going to make a lot more income in a few
mhm,
years. Okay, what's going to drive that income? They're going to renovate the units as an example. They're going to drive up the rents. Okay, that makes sense. Where are they going to get the money? It's going to be from the cash flow. How's the cash flow doing good? It's because the rates are low. And so that allows them to have a lot of cash flow. Now, all of a sudden, the interest rate spiked 3%. Guess what? You're now paying way more money to the bank. Guess what? Your
yeah,
cash flow just went down. Guess what? Your units aren't getting renovated. Guess what? The income's not going up. Guess what? Your IRR just tanked.
yes,
So there's just this kind of flow of things that happen. And so as an investor, it's important to understand what are the drivers that could potentially cause the return not to come. People get very excited over the PowerPoint and get excited over seeing the number, but they don't ask the hard questions, which is what are the drivers that cause that number to be what it is? And what are the things that could happen or that could potentially cause the knobs to turn in a way that return isn't going to show up? What are those risk factors? And people get too excited about the numbers and don't spend enough time on the due diligence to say, what are those numbers? Are they realistic? I'll give you a
yeah,
great example. From a due diligence standpoint, I've done a lot of deals, right? And so I've seen a lot of analysis. One of the first things I always ask a sponsor before I invest is show me your T12. They're like, why? I'm like,
hate that.
I want to see the 12. And they're like, Why do you need to even see it?" I'm like, "Well, you've made a whole bunch of projections here on a 5-year spreadsheet. I just want to see how did the property do the last 12 months? Show me the
Mhm,
data." Finally, they show me the data. I look at it and I go, "Okay, so the last 12 months you made X. Year 1 now, you're saying after you take over the property, you're going to make it go up by 30%. Interesting. And how are you gonna do that? Oh, you're gonna renovate half the units? Really? And then as soon as you dig in, you realize that there's potentially a bunch of BS in the numbers, and then you go,
mhm,
"Okay, I'm not investing in that deal." So I
yeah,
think some of this is there's good deals, there's bad deals, but in the end, as a passive investor, you have to do due diligence on anything you do.
yeah, but at the same time, I have 2 questions that kinda leads me to it. I'm trying to think, which one should I ask you first? Because on the one hand, as a founder who does a lot of passive investing, it's unusual. Most founders are pouring every dime and dollar they have back into their own business because these businesses are hungry, thirsty, expensive little things. And we feel like if we put money other places, then we're letting our business down, we're letting our employees down, we're letting our partners down. Like every drop of sweat and tears has to go back into the business. How could you speak to other entrepreneurs who are still maybe in the hungry phase of the business to encourage them to say, "Hey, you have other things you need to invest in besides just this business." Like, how do you allocate your income to feed a hungry business and also take care of your own passive investing, avoiding that founder
You
trap?
shouldn't feed a hungry business. That's probably the first mistake you'd make. You have to decide what the startup investment amount is. And
Okay.
that's what we did with our business. And
Mhm.
we said, okay, this is our startup investment. This is what we're going to do to get it off the ground. Then you don't just keep throwing money at it. You got to decide what is it you're trying to achieve with the money and how far are you going to try to get and what milestones are you trying to achieve with that money before you go for more money. And chances are I when you as a founder, you definitely do not wanna completely tap all your money. Yeah, you hear about people doing that. Majority of startups fail, right? Especially in the software business, right? Most
Mhm.
startups fail because they underestimate the investment it takes to run software. But if you're in that space of saying, "Hey, I wanna go start my own company," I would say pick a reasonable amount of money, whether it's 10%, 15%, and say, "Okay, I'm gonna invest 10 or 15% in this business." And yes, it's your business, but keep the other 85 invested where it was, right? And if you have $1,000,000, you say, okay, I'm willing to invest 100, 150. If you have $500,000, then you start with 75 and say, what can I achieve with 75,000? And
Mhm.
you try to go build an MVP around the money you have and get creative and don't go raising a lot of capital. That's the one thing we've never done is we didn't go that route of round and just keep dumping and raising capital because the more capital you raise, the more you lose track of the pennies it takes. At the end of the day, you want to build a business that's sustainable, not a business that's $20 million under owing people money. If you're going to go start a company, number one, don't throw everything into it, and is my guidance. Pick how much you want, and then that's your investment amount, and then say, what are you going to achieve with that amount? If you achieve that, then what is the next step? And do you go do a small friends and family round? Do you go do it and then show them the progress you've made? Then say, here's what I'm going to go do with this next chunk of money, and then be very wise about how you use that money to go do exactly what you said you were going to go do. You have
Mm.
to set goals and you have to hit those goals. And if you miss them and the biggest thing I think people make is at some point, you either have to look at it and go, okay, I have found a product market fit for my business and I found something that has product market fit. Or you say, you don't have it and you say, it's time to pull the plug and don't keep chasing something
Yeah.
that may not be, that's where companies lose
Sure.
money.
So right after I got out of high school, I think I learned a metaphor for this lesson. I was a nanny actually for an oncologist, had a massive practice, and he was talking about end of life care for doctors and how different it is than end of life care for your average cancer patient. And he said at a certain point, you just have to know like when we're not throwing more money, more time, more pain, more effort at this, and just going quietly. And so, as an oncologist who wants to help people fight cancer and help people heal, he said at a certain point, I just have to tell him, let's
Yeah, it's
palliative
done.
care kind of kicks in. And so you have to make those decisions as a business owner. We're going to fight. We're going to throw money at this, but it has to be in a reasonable, measured way. And you also have to have an exit plan in case it fails. Like, at what point are you
Exactly.
going to stop crying over this and just say, let's plan end of life. Let's plan hospice for this business. And having those decisions ahead of time really can help. And I've just seen we've been in the founder world for a while, and I've just seen a lot of founders, a lot of decisions, a lot of things that they're willing to do, I'm not willing to do. But then a lot of times, like just trying to throw everything at it, and it just causes more pain than it solves. They lose their homes or get
Yeah.
divorced,
And part of
whatever.
it is you're too caught up in your idea and you're not listening. And that is a big reason for failing. You have to listen to what people are telling you. You have to listen to your customers and the feedback they're giving you, either directly or indirectly. And you have to know when to turn because you are definitely, and we've learned this over the last 5 years, you are not going to predict where you're going to go. And you have to be willing to just listen to what your customers are telling you
Yeah.
and adjust your plans because in the end, the customers are the ones that are paying you. And if you don't create enough value for them, they're not going to keep paying you
Yeah.
and or even pay you anything, right? There's one area that's always interesting, and I've always been against it, but I see a lot of startups do is they give away free things, right? Like a free plan. Oh, try us out. I've always been against free plans because I think it's great for the consumer. It really hurts the founder because if you're a founder and you have a bunch of people using your product for free, you're never going to get the real feedback because it's not hurting their wallet. It's only when they're paying you do you get good feedback in my mind because and I know people will disagree with this 100%, but this is just my view, right? We've never given away our product for free. And it's because my belief system is when people pay you money, they're going to be much more harsh with you than when they're taking something for free from you. And so by charging money from day one, I think what we've learned is we've gotten very good feedback from our customers and we've got the crap beat out of us by our from because when you're charging them, they get mad. And when they get mad, they tell you the truth of what sucks about your product. And at the end of the day, taking those bullets makes you better. And so I am very much opposed to I'll use everybody's free plan. I don't care because I'll take it for free. But things I've used for free forever and I'm never going to upgrade because they're dumb enough to give it to me for free. So I'll take it for free, you know?
Oh, goodness. I'm just laughing because I've been the fly on the wall when Chris and Troy are firing bullets at you. And I think that's one of the nicest things about what you're talking about. It's, hey, we want two-factor authentication. We want single sign-on. The accounting has a bug or there's a problem with the login. And we just call and because we're paying for it, like it has to work. But at the same time, it's
Exactly.
like we understand from being in the software startup world that there's an iterative process where sometimes stuff doesn't work, but at the same point, it's a very strange back and forth between this has got to work, but we understand that it's not always going to work. And it does get tense sometimes. So tell me about that. Tell me about the reality of dealing with, like you said, that harsh customer feedback that this feature doesn't work or this cost is not delivering the value I was expecting or whatever. How do you handle that as a founder?
You handle it with grace and you take it because here's the thing. If you stop getting the feedback, you're going to go out of business. You have to, you want the feedback. I want the feedback as a founder because I get scared when my customers are not calling me and yelling at me because I start worrying, are they using the product?
Mm,
Silence is scary. When
that
people are yelling at you,
you
as
really know
painful
what
as it is to take
are.
pain, they're using your product. That's why they're
Yeah.
yelling at you, right? I've always looked at it as a positive, which is I look at every piece of feedback and every yell I get from a customer, every call that somebody's mad at me. I take it back and I say, okay, this is one more reason to improve, right? This is
Okay.
one more reason to try to make our product better. And that feedback is extremely valuable in my mind. So
Okay.
does it hurt? Absolutely. Do you feel bad? Absolutely. But you know what? Does the team feel bad? Absolutely. And nobody likes to get criticized. But in the end, you're building something for your customers that they're paying you for it. And you need to create more value than what you're charging at the end of the day. So if they're saying it's too expensive, the reason they're saying it's too expensive is they're not seeing enough value. Okay, what do we have to do? And so that's where we are a premier platform, right? I always tell my team, if you think about like retail, you've got Target, you got Walmart, you got Kohl's, you got Nordstrom's. We're on the Nordstrom side. Full
Okay.
service, high quality. Yes, we charge more, right? People come to us and say, you guys are expensive. Yes, because we give business advice. We give regulatory guidance. We give a lot of stuff. We're not just a tech company.
Yeah.
And we provide full service. We'll solve whatever problem the customers need and we'll help them figure it out. And it's different. And so I'd rather be on the Nordstrom side of the world because
Okay.
I feel that's the brand that level of quality brand is what we're looking for. I'm not looking to, so you have to decide as a founder, where are you playing? What are you doing?
Mhm.
And what level of service? I like the ability for our customers to pick up the phone and call us. A lot of people say, no, we'll only do email support. So it really depends on the kind of service and the product and what you're trying to build and what brand you're trying to build.
Yeah. Volume is expensive to service because you have a lot of customers. And so in our fund, 80% of our capital comes from 20% of our investors. There are seven
Yeah.
figure check writers, but then 80% of our customers are putting in 20% of the revenue or taking up 80% of our customer service, which I don't want to diminish that because we need that 20% of the revenue to keep working. It's just part and parcel of it. But at the same time, it's like when this is fun. It's funny to me because Troy actually edits this podcast. So he's going to love listening to this section and be like, you know what? He's very nice. He's very kind, but he doesn't want to call and give, hey, this isn't working or I need some help with this feature that he's my in-house IT guy. So I make him fix all that stuff and take it as whatever it's not working. Call Sandy, take care of it. That's where I come in there. So it's going to be interesting when he listens back to this. So then tell me a little bit about one of our issues as a fund. My daughter said it best, like last year, we were really struggling because capital raising right now is horrible. I'm seeing
It
this
is.
starting to pick up. Like people are feeling more confident. The election's over, holidays are over. We're definitely seeing a little bit of an uptick. But we really lived through about 18 horrible months of wondering, like you said, this we've got high fixed costs, expenses as we bring on more investors, our variable costs are going up. And my daughter was overhearing, like, we've got to come up with a plan to stay the distance because we know that this dearth of capital raising is not going to raise forever. And she summed it up. We got off the phone call and she said, it sounds like right now you're in a game of he who doesn't quit wins. And so we were listening to our customers, like you're
Yeah.
saying, but then you're like, why isn't anybody investing? Like, how long can we continue to afford to do this? And we had faith that it's a downturn, it will recover. So, what do you do during that time when you've seen this capital dry up and your fund managers are like dropping like flies, or they're like, we just can't raise enough money to be able to afford? Like, how were you able to work with your fund managers to get us through this last 18 months?
Yeah, I think one of the things you always have to do is when things are bad, you double down because everybody else is backing off, right? And so it may sound like a riskier strategy, but in the last 12 to 15 months as a company, we doubled down, right? Everybody else is like, hey, this is not a good economy. Things are slowing down. Things are bad. I'm like, double the engineering team. That's what
Yeah.
I said. We need to double the engineering team right now because we're going to move faster because
Mhm.
it's not a good time and we're going to double invest. And that's the path we've taken. And now things are, as you said, it is a turnaround. I've seen a significant change from this month where things are a little bit more optimistic. Money and deals are flowing more on the platform. We're seeing a shift happening. And I think investors will start opening up their wallets a little bit where they've been super tight. When things are slow, you figure out how to take advantage of that situation, right? And become more visible, right? And get in front of more investors. They may not invest immediately. That's the time when others are pulling back is when you want to
Mhm.
really get in there and be more visible and try to show your differentiations. I would say investors are resistant. I think they will open their wallets, but they need to find the right opportunities
Mhm.
and they need to be convinced that what they're investing in is truly a good opportunity, even in the current market. So I think you have to spend a little bit more time, a little bit more energy to put together, whether it's you're offering your webinars, your marketing materials, your collaterals, and you have to spend more time explaining to them why in this environment, it's still good to invest in that deal or this
Mhm.
offering. And I've been amazed with some of the investment opportunities I'm seeing on our platform right now. There are just some fantastic opportunities flowing through. And I think there's nothing else that you can really do. You could pull back and be scared and wait, but that's not a winning strategy, right?
What's the difference between knowing when your customer is telling you that, you know, that your product is not delivering value and I don't want to buy your product? It's like time to shut the business down. We've invested enough in this. We gave it a fair run. It's time to walk away. Like we're talking about like palliative care versus being able to say, it's a rocky patch. Because there's a certain amount of self-denial that founders who are hanging on too long have to go through to be like, it's a rocky patch. It's not a rocky patch. This is not a good product. Versus saying, this is a good product. We're just in a hard time. Things will pick up. We need more exposure. The economy needs to turn around, whatever. What's the decision making matrix between those two possibilities? And how do you get out of denial to say this company's not working? I'm quitting versus we just need to get through a rough patch.
I think it's pretty straightforward, which is people walk with their feet, right? And so if you see your customers are exiting and they're not willing to pay you, you got a problem as a founder, right? And if you're giving away a bunch of free stuff and they're not willing to upgrade, you got a problem. You
Yeah.
don't have a value proposition because if they're taking a bunch of your stuff for free, but they're not willing to give you whatever, $10 a month, $20 a month, 100
Yeah.
bucks a month, whatever you're charging, you have a fundamental problem because you've not created the value that is causing them to open up their wallet. So, as a founder, I think you have to look at what your customers are doing. And if they're staying on board and they're yelling at you, okay, that means they're mad, go fix it. But
Mhm.
they see the value in that they're not walking. When the customers start walking and then you start losing customers, that's when you as a founder, or you just can't get customers to pay you. That's when the fundamental issue is. And that's where you have to open up your eyes. So I see a lot of startups that they have their free plan and then they have their $20 a month plan and then they have their $50 a month plan, good old good, better, best. The problem is nobody goes from good free to the better plan where they're making money. So then as a founder, you better be saying to yourself, I've got a real problem here. If I can't get 10, 15, 20% of my customers to upgrade and upgrade quickly, that means there's not enough value that I've created in that middle plan. And I better figure out and invest to find the way to create that value quickly.
Right. Mhm.
Otherwise, you're going to be out of business.
Okay. Yeah. As fund managers, we don't have anything we can give away for free. We sell investments. You either invest and you get money back, or you don't invest and you don't get money back. So the only free stuff that we're giving away is like information, because we're not an information company. We don't sell information, we sell investments. And so we've never really gotten into that trap of offering too much for free, because you can't offer
Yeah.
invest for $0 and we'll pay you as a trial run. That doesn't exist in this.
But it still applies here. Okay, let's take it in your case as a fund, right?
Yeah.
If you can't get investors over the finish line to
Uh-huh.
invest with you, you have to step back and say why. Because
Yeah.
as somebody who has 200 funds on the platform, I'm seeing plenty of investors investing. Okay. So the money is flowing because I see
Mhm.
all the money flow through our platform. Right. And so the money is absolutely flowing. So I always say to our fund managers, if you are not able to raise, don't go blame the investors. Look in the mirror.
Yeah.
And I hate to be that blunt, but the fund managers that can't raise is because they don't have their shit together. And it's painful to hear that. Nobody likes to hear that. But there are plenty of people that have open wallets, even now in this environment. Yes, things slow down, but there are plenty of people that are still looking for good. So if you're not able to convince them, you are competing with a lot of other people out there with investment opportunities. The money's flowing somewhere. It's not all sitting in cash. Okay, so if that money is not flowing to you as a fund manager, and I'm not talking to you specifically, I'm just having, if
No,
you're,
that's a reverse of what you just said. It's like you want the harsh criticism, but you're able to then give that back to fund managers who are struggling. We can't afford the whatever the platform, but you're like, how about you go raise more money? Maybe then it. So that,
here's the biggest thing is I always tell our fund managers, they're scared to take money. So they go, oh no, I want to give my first deal. I don't want to make any money on my first deal. I'm like,
uh-huh,
absolutely not. And I have said it over and over to every starter manager that starts it and says, I want to go give this away for free so I can convince my investors. Okay. What you're saying is your time has zero value. When
yeah,
you're giving stuff away for free, that means your due diligence time has zero value. All of the time you spend putting things together has zero value. You're devaluing yourself right from day one when you give yourself away for free. Instead, you should be saying to your investors, here's all of the stuff I am doing that is saving you time. Here's all the due diligence work I'm doing. Here's all of the analysis work I'm doing. Here's all of I'm talking to the sponsors. I'm going and checking out the properties. I'm going to go do all this stuff. This takes time and energy. That is what you are paying me for. If you want to go do it, you can go do it. They'll be like,
yeah,
no, I got my full-time job. I just want my 8, 9, 10% return. Okay. You want your 10% return. Don't complain to me about making a couple percent because I'm the one doing all the work.
yeah,
So you have to be able to, when you're in the business of raising capital, you have to be able to explain what your value proposition is. And you have to be able to say, it's just like a product. If people aren't willing to pay you, either their perception is you're not doing enough, right?
mm,
That's why they're not willing to pay you. So you have to then say, okay, how do I explain to them all of the stuff I'm doing for them so that they see the value of paying me the money? And so I always, whenever a fund manager comes to me and says, hey, I want to give away my deal free, I said, no, you need to learn how to charge people money and convince them that they should pay you because you're doing them a favor by doing a bunch of work that they're not going to be willing to.
Yeah, that's the whole crux of it. I think sometimes it competes with my, "Hey, we have a passive income lifestyle. I climb to the top of mountains and travel full time with my kids, but yet I work my butt off on your behalf." You can have passive income like me and work your butt off in a business or volunteering or whatever. It's a tough message to juxtapose on social media. Do you see any conflicts there? Because when you get to the point where you don't have to work anymore, I think this is the message maybe. When you're like, "I could retire, but I really want this challenge," like what you're talking about, and conveying that I work my butt off because I'm passionate
Want
about
to,
this.
not I need to. There's
Yeah, but I still wanna get paid for what I do. Like, that messaging sometimes is
But I think you have to separate out 2 things, right?
Mhm.
One is I have fun. I go on vacations. I do a lot of
Yeah,
fun stuff. Okay, but when I'm working, I'm on, right?
yeah,
I am completely on. And when I go on vacation, I try to be completely off. Not that I am, but I try to be completely off. So I think you want to separate those 2 things. There's a personal side of everybody's life that you want to communicate and highlight and say, hey, I too can have a great life. And I've been able to do this because of passively investing in a variety of different things, which is giving me ongoing cash flow, which now allows me to go have fun in my life without worrying about the stress. But when you're talking about being a fund manager, that's about being on. That's the
yeah,
on part of your life. And you have to explain to them when I'm on, I'm fully on for you. I'm working my tail off and here's all the things I'm doing. So part of it opening up the capital is there's a trust factor in the manager, right? And then there's a trust factor in the deal. And both of those have to come together for you to be able to raise capital. So you
yeah,
really say to yourself, okay, how do I, number one, have this person trust me enough that I'm doing enough work on their behalf that they want to invest with me? And then number two is the deal I'm giving them. Why is this a good deal? Why is the risk low? And people spend so much. Here's my recommendation. If I was giving you a recommendation on what to go pitch, talk about all the risks on the deal. Say, hey, I've looked at this deal. Here's the 5 things that could go wrong on this deal. Here's why I think these 5 things aren't going to go wrong because of my due diligence, my work, my analysis. And that's why I think you should invest in this deal. Why? Because you're addressing the things they're not asking you, which is
yeah.
going to go wrong. So start with what's going to go wrong. Tell them, here's the 5 things that could go wrong. Here's why I don't think they could go wrong. This is why I think it's a good deal.
That's
Yeah,
what everybody else says.
it's in the back. They're going to go bullshit, bullshit, right?
Yeah,
Hit the things head on. And I think
okay.
that makes capital raising a little bit more better. I've got this session. I don't know if you saw it that I did a couple months ago in our mastermind where I told the fund managers, here's the top 10 reasons why investors are not going to invest with you. And the 10 things they're not going to tell you. So I went through the top 10 things that a passive investor will never tell you to your face,
Mhm.
but they're why they're not going to invest with you. And a perfect example, which people don't even realize, is they're not aligned with their spouse. And
Yeah.
it's a simple one, but if you don't ask the question, like if you've got a married couple you're talking to about making a $50,000 investment, if you don't ask them, hey, what does your spouse think of this deal? You're not going to know if they've even talked to their spouse. They'll say, oh, this is amazing. Then they'll go to their spouse and it's a joint decision. And the spouse will say, you're crazy. We're not doing this. And guess what?
Mhm.
Now they won't tell you
I'm
that.
not doing it.
Just say, "Hey, it's not the right time." Sometimes it's not what they if you don't ask the right questions when you're raising capital, you won't actually know why they're not giving you the money.
Yeah. I hear a lot of feedback from our existing investors. It's just like what you said. Now that they're in the fund, they're investing, they put in money, so to speak. And now they're giving us real feedback on what they think of the deals, what they think of the customer service. Like it's the same thing you're talking about, but it's the ones who don't invest. That's like the free thing. They looked at it for free. They kicked the tires around. They're actually giving us useful feedback because they never bought anything.
Yeah.
So they can tell, and they don't want to give us that harsh, hey, I'm not investing because of these 10 reasons. We don't hear that. We're saying, it's just not a good fit or whatever. The real feedback is the ones from the people who are already in it. And they're telling us exactly on the next deal, could we see something like this? Or I really like this, but this would work better for me because we have people who are now in our fund who are telling us exactly what kind of investments. Since ours are so short term, we can be really nimble that way. That feedback is really valuable. And oftentimes when people decide not to invest, they're too polite to tell
Well,
us
but
like
that's the
the
thing.
actual reason.
I think they're polite, but when you're going and talking, you've got a lead generation path, right? And you're talking to
Mhm.
investors. And at some point, the investor just, you don't get them over the finish line, right? But during those calls, if you don't ask the questions on what are those factors, they may not want to tell you they don't have the money
We're
right.
going to offer it. They have
Right.
to,
You
yeah,
have to
yeah,
ask the question, hey, I'm going to show you this great deal, but is this a good time for you to invest or you don't have the cash flow to invest? Never ask the question. You're never going to get the answer. Right. And just out of curiosity, do you make the decisions by yourself or should we have the conversation with you and your spouse together? If you're jointly going to be making this decision, it might be better for us to meet together.
yep,
If you don't ask them that question, guess what? You're never going to know. Right.
yep,
And those are the types of things you have to tease out. But I think, again, it's easy to go and focus on the people that have already invested with you. I would challenge you to go get the people that didn't invest with you and ask them why.
yeah,
Because and not everybody, some will be polite, but some of them may just say to you what you don't want to hear, which is, I don't think that your deals are good. Or they may say, I don't trust you guys. That's the
yeah.
number
All
one.
those I can think of 100 other things they could say that would be like, "Okay, that's a you thing, not a me thing." But when it's a me thing, oh man, that's hard to hear.
It's the number one reason why an
Yep,
investor does not invest with a manager. I don't trust you. It's
yep,
a very simple thing that it's very difficult for the investor is not going to want to tell you to your face. The manager
yep.
is not going to want to hear it, but it is the number one reason why people don't invest with specific is because they don't trust you. They don't trust you have the skills. And the other one I always told managers, which they never want to hear, is the investor is just going to say, not going to tell you to your face, I just don't think you're that smart. And
Oh,
no, I'm
how
very serious. They're
well,
not
it's
gonna
ouch
tell
though.
you, I don't think you're that here's the thing, a sophisticated investor is gonna ask you a series of questions, and it's an
Mhm.
interview. And if you can't answer those questions, you're gonna really quickly if somebody comes to me and asks me about a deal, and I say, again, we'll take a simple one like multifamily, right? Let's just play it out. And I ask you a simple question. Oh, okay, this is your 5-year return. That's great. What was the revenue last year of the property? And you go, yeah, I can get that to you.
Let me get my financial manager, to give you those numbers that I
Okay,
should.
all right. You're selling me a deal, but you don't have the intelligence to know what the revenue was in the last year, but you're pitching me a deal. Okay, that's a very basic information. If you don't know it, as painful as it is,
Agreed.
that person's gonna be like, okay, strike one. And so when they're talking to you, they're interviewing you. And so the question is, intelligence matters, data matters, details matter.
Mhm.
And if you don't have them and you don't know it, it's going to reflect on your intelligence, as painful as it
Yeah,
is.
yeah.
And
You're
that
you're absolutely right. People send out pitch decks, and I'll ask other syndicators because I have in the club, we have a lot of young new capital raisers in there, and I'll say, "What's your biggest fear?" And they'll say, I'm afraid of the numbers." I'm like, "What? You're in a financial business, and you just
you
put
know,
out
be
a
afraid
pitch
of the
deck,
numbers.
bunch of numbers." If it's in the pitch deck, that's going in your PPM, by the way. You have to know what's in your own deck that you're expecting a layperson to understand.
Yeah.
But you, as the salesperson or the capital raiser or the deal operator, don't get it and you're afraid of it, but yet you think this passive layperson is gonna understand it, a retail investor? No. To me, there's no excuse for not understanding the basic fundamentals. Yeah, what's in the pitch deck. But yeah, that's an interesting exercise because I feel like it's easier to ask the questions that you're talking about before they say no. After they say no, there's really
Harder.
that is just an autopsy fact finding. There's no way I'm gonna be like, "Oh, now that you've said no and you've made your decision, let me ask you all these questions and see if now I can change your mind." So then it's just a lost cause. So a lot of times people just don't ask because they're not going to try and change their mind. Asking those questions before they've made a decision saves people time, right? Because if they don't have any money, of course, call us back when you do. Let's just give you some information for down the road, whatever. Do you have a co-decision maker that we should be meeting with, a follow-up?
Exactly.
No, they tell me everything, whatever. Like not asking those questions ahead of time gets you to the point where now you're asking them as an autopsy instead of as original fact finding.
And you may not get their time anyways to ask them.
True. "Hey, can you
Uh,
do me a favor and answer a few questions about why I didn't invest?" That's a super awkward conversation.
and also the other thing is when you're in the middle of those conversations, if you can figure out those resistance factors, you can very quickly
Mhm,
know, okay, do I need to present a different set of material to address those
mhm,
resistance factors? Or is there nothing
mhm.
I can do? And then you just say, okay, this may not be the best time, but let's keep in touch. And when we have our new deal, I'll reach back out to you. And I think it's really important to not be in, I think what happens with sponsors, fund managers, everybody, they get so caught up in pitching, they forget the listen mode. And
Yeah,
because they're too busy selling, they're not
selling,
actually listening to
jumping.
the investors' feedback. They're getting either visual feedback, they're getting verbal feedback, or just general, they're not listening to what's happening. And because of
Yeah,
that, they're not catching where the issues are. Visual cues are very important. And I think part of it is when you're face to face with somebody, it's easy to catch those visual cues. On Zoom, it's actually a lot harder. And so I think as folks that are raising capital, you really have to look for those visual cues and not get too caught up on your slide and presenting your slide. Because the problem with Zoom is if I'm showing you my slide, your screen has just gone really, your picture's gotten really small.
Yeah.
So now you're not going to catch those visual cues. So it's really important that you don't spend too much time looking at the slide and spend the time looking at the person and the investor so you can catch the visual cues. Because if you're busy reading your slide, you're not catching their cues on, ugh, oh, or whatever they're
Yeah.
doing.
Because then that you recognize that discomfort, and that's the tip to say, "Here's where I slow down and ask some questions because signs
Exactly.
of discomfort." And if yeah, I don't share slides because of that reason, and I feel like having no slides hurts me because then I'm like, "Oh, then I'll send you the slide deck as a follow-up," and then it starts this thing. So there I think there's a balance there between relying, "Here's my slide deck, sit still, and I'll present for 30 minutes," versus having a couple of visuals to help explain what you're doing and not turning this slide deck into a follow-up nightmare. So you just always keeping an eye out in that balance of being able to raise money. And that's one thing I like about what you do because you've got your regular meeting that I can start attending now because I moved my schedule around. And so the people you bring on, the marketing, the fund management, like the actual nuts and bolts that we as your customers need to be successful, that's the information that
Yeah.
is valuable because you see a lot of funds and you see a lot of business plans. And now you have, as a passive investor yourself, but now as a platform manager, you see a lot and sharing that knowledge with us. Just like when I was listening to
Yeah.
Badri talk, I'm like, oh yeah, dude knows what he's talking about. They're not just playing around here as software guys. Like they actually swim in this pool with us. Yeah, very fascinating. I love the way you guys do it. Can
I'm not
you
sure if
kind of
we
oh
actually
yes.
added another session now. So we have 2 weekly sessions now. One is our
Okay.
mastermind and one is deal sharing Thursdays. And so what
Yes.
we're having to do is deal sharing Thursdays is an opportunity for sponsors and managers to pitch and receive direct feedback from us. Sometimes it's a real deal, sometimes it's practicing for a real
Okay.
pitch, but we're providing guidance, advice on holes, gaps we see. And it's also an opportunity for managers to listen to other managers and operators that are trying to pitch their deals.
Yeah, I need
And
to because
so,
our club is more like multifamily equity. So I took in my pitch deck and I said, I'm going to put this in front of you and I want you guys to just tear it apart. And I came away with just completely restructuring the entire deck. And I thought it was very valuable. So I need to, once I get the new deck done, come in and have you guys give some of the harsh feedback and tell me how it is. Cause I think that is what helps us, makes us better. It's not only making us better marketers or salespeople, I think underlying it makes us design a better product that has more
yeah.
value and is a better fit for our customer. And that's really what we're all about. I don't want to sell something that people don't need. I don't want to sell something that then they have buyer's remorse. I want to make sure that what I'm selling is actually useful, helpful, and valuable. And that's what you guys have done with investors. Like you eat your own dog food, so to speak. Like when you are testing it out, you're doing your thing and it benefits me as a fund manager because it gives me a product that I can promote, but also it benefits our investors who are struggling with some of the same issues that you were struggling with. Just as wrapping it up, tell us where Investor is going over the next few years. I don't know if you want to talk about maybe some new features you're working on or a grander vision. Like just share with me what's coming up for you with the business itself, and then maybe a few of your own personal goals that go alongside the success of this platform.
Yeah, I think for us, what we've realized is we started out on the tech side, right? Really building the tech. The tech is continuing to get really better. But what truly is exciting me is the community because we've got over 350 managers on the
Oh
platform now.
wow, that's
Uh,
grown quite a lot.
yeah, a couple hundred funds. And what's really amazing about it is so exciting to see all of the deals that are flowing through and how much, for example, just yesterday in our deal sharing Thursdays, we had a manager pitching a 1,600-acre new development they're going to be doing in Arizona for luxury homes. A couple weeks ago, we were talking to a guy who's in the Outer Banks of North Carolina. He's about to launch a development project for homes in the Outer Banks, which is an absolutely gorgeous area. We've got guys about to launch a set of doctors that are launching a fund that are basically going to be buying medical practices. An investor could go buy into a medical practice. What gets me super excited about my job is the community and learning about what everybody wants to do and the types of alternative and passive investments that people can go into. It's so broad and it's wild. One of the biggest things for me in 2025 is to build out our community to make it even better and stronger and really
Good.
bring together folks like you to partner with operators that are looking to partner with other fund managers and an opportunity to bring those together into a community. And in the end, that opens up the door for your investors to have even more unique investment opportunities that they would otherwise never find anywhere.
Yes.
So to me, when I look at my long-term vision of where I want Ivester to go, I want us to, we're already starting to become a place that hundreds of deals at any given time are available on our platform. But I really want to get us to a place where it is the ecosystem of all deals, right?
Mhm.
Where any investor, or at least right now, high net worth investors that are looking to diversify, they have an opportunity, and the managers that are on the platform can provide a huge amount of investment opportunities to their investors through their private funds and really give them diversification like they've never had before.
Does that hint at potentially becoming a crowdfund portal? I'm hearing?
No, I wouldn't. See, when crowdfunding is very different in my mind, where you're just throwing money at things. I'm not a,
Like 5 grand here,
yeah, if I,
$500 there, yeah.
yeah,
No,
this,
not in the cards.
no, to me, it's all about relationships, right? And private offerings to me is very different than crowdfunding, where in private offerings, the managers are they're building relationships with their investor base, and they have these relationships. And to me, those relationships are very important because it's a matter of trust. If you're going to be investing 25, 50, 100,000 bucks, crowdfunding is 1,000 here, 1,000 there, 500 here. There's no
Yeah.
relation. It's not a relationship game. It's just a transactional game where I'm trying to build a relationship platform, right? And so I want to provide the managers and their investors with the ability to truly diversify
Mhm.
and have more and more opportunity. So I view it more about it's more in the line of a marketplace model, right?
Mhm.
Where I want us to have so many different opportunities that you as a manager can pick and choose which ones are best for your investor base.
Yeah.
And you can partner with managers to be there.
Yeah. What type of functionality does it have right now when you're logging in? I have so many questions. I could keep you for another couple of hours, but I can try to wrap it up. But when an investor logs in, are they able to see the ecosystem of deals currently where they can see my fund along someone else's fund and they can, or because we
No.
have our single portal, they log in, they only see my deals. Is that something maybe that you want to bring into the community feature eventually?
Eventually, what we want to do is, yeah, I would like to have a marketplace, but it's the fund manager's decision.
Yeah. If they
I
want
want
to
fund
participate.
managers to decide if they want to open up their deals, other investors or not. I don't want to do a standard marketplace where all the deals are there and everything because relationships matter. And
Yeah.
it's important that relationship between the investor and the manager is there. In my view, it'll be a different kind of marketplace. It'll be an opportunity for managers, just like managers today can decide what deals are going to be in their platform or in their fund. I want managers to decide if they want to more broadly advertise their deals or not. Because sometimes
Yeah.
managers already have their investor base and they're
Mm.
comfortable with their investors and they don't want to bring in other investors. And sometimes
Yeah.
it'll be much more manager controlled is what
Okay.
we're
Yeah.
looking at.
That makes a lot of sense, especially I'm seeing like in our what we're doing, our multifamily is more fund of funds because we're not going to be purchasing or running our own deals. I don't know anytime soon. So we're looking for other operators now. Now that we have been operators and we still are managing several multifamily properties, it makes us better consumers as a fund of funds to go find. Okay, you're the guy that I want to raise capital for. But in the hard money side of what we do, we're just recycling money because they're short term. And so
Yeah.
we are going to get to a certain point where we can't take on new investors anymore because we have enough recycling that we'd have to go out and find new deals. Because right now we're turning down most of the deal. So I can see what you're talking about. At a certain point, you're like, yeah, we actually like who we're working with. We've got a great recycling fund. It matches our deal flow. We're good to go here. And then, but maybe say putting it out there that we're raising capital for a specific deal, like a fund of funds for an equity deal, having some customizable control over what deals are being shared in the marketplace, that's some I don't know if you're working on that, but I think
Yeah.
that for our fund particularly would be really helpful, share some deals and and not other deals. Because we have some deals that are taken up by a single investor, a hard money loan
Exactly.
who wrote 7 figures and they're like, "I can afford 2 houses by myself and we don't wanna share." We don't even like, it's hidden on the platform because that's their own deal.
Yeah,
So
in the end, for us, we're a B2B platform, right? And so our
mhm,
customers are our fund managers. So we want to, from just the standpoint of what we want, we're going to make sure that we're doing what the fund managers want us to do, right?
okay.
That it meet their needs. And so
Yeah,
that's why I always go back to it's a fund manager control. because if the manager is an operator, sometimes our operators have a smaller deal that they want exclusive for their investor base. Operators want to go with a deal that's much larger and they want to bring in other fund managers and their investors. And
Yep.
I always view, let the managers decide what they want to do with their deals.
Yeah,
Yeah.
and it's the same functionality you're currently offering for investors. They get in and they can flip the switch on those. One thing that I wouldn't say experimenting with, but we experimented with a while back was to just have a placeholder deal because we have so many different ways we could allocate. It's just soft commit the full 50K to this deal, and then we can allocate that 50 across multiple deals. So this placeholder continuous offering. And so working with you on that process, I think we've got kinks worked out of that. We have a lot more things that we want to do as well. And it's so great to be able to call you and say, hey, I want to run an idea by you. Troy's still really wanting to do some sort of, and we haven't talked about this, so maybe I should bring it up, but still wanting to put up a nonprofit or a charitable deal as a deal that they can roll their returns into instead of rolling
We've
it into
had
another
a
one of our
few
deals.
people ask us about that. I am looking
Yes.
for a fund manager trial partner. Such an exciting opportunity for me.
Yep.
I'm totally in on that one because there's so many investors that would love to take a portion of their earnings and donate those earnings
Good. Yep.
or do it in this has come up numerous times. And so I definitely want to support it as soon as I've got a manager ready to go. But
Oh,
ask me about, hey, is there a way we can build functionality to allow a nonprofit offering or something like that? And so I'd
yes.
love to work on that one.
I know that we were waiting for, oh my goodness, there's so many numbers. What's the nonprofit? 503C or whatever it's called. The numbers all get mixed up
Yeah.
after all. But getting that nonprofit paperwork done, I think it's done. So let's chat offline and see if we can
Oh, sounds good.
that one put up on our portal and start working through that because Troy kind of thinks money is stupid. And one thing that really motivates him to run this business is helping other people. And so he's very passionate about getting this project
Be awesome.
eventually off the
Great to
ground.
work
So
on it.
yeah,
So,
keep your eyes open. I really, oh goodness, I have 1,000 more questions, but I'm just going to have you back again in a couple months. Yeah. How do people find you? Spell out Ivester so that they can go check you guys out as their fund manager? And how do they get a hold of the fund managers on your platform if they're a passive investor?
so if they go to avar.com, that's our website, avester.com, there is a marketplace there. They can see a variety of different funds on the marketplace. There's a way to contact the managers directly from there if there's something they're interested in. But we really allow the managers to then reach out to the investors. We don't get in the middle because it's the manager relationship that we're trying to build.
Yes.
But yeah, direct investors can get an idea of some of the funds on our platform if they go to our website. And then if they want to get a hold of me, LinkedIn is probably the easiest way.
Yeah, and I know that I've never given this link out on this podcast before, but if you go to investerinc.com/rise capital, you can go and log in, create a username and password, and see all the deals that we currently have. So each fund manager will have their own branded portal. So ours is /rise capital, and others will just be slash whatever their business name is. And so if you want to find us, reach out to me, reach out to Sanjay because we can introduce you to some other fund managers as well, because we want to be one of the places that you invest, but we understand like the power of diversification and the networking and the introductions are really what we're here for to help you with a portion of your portfolio directly, but also just to be able to introduce you to some other people who could help you get into the private equity world in a way that has your risk diversified across several places. So thank you so much, Sanjay, for the conversation. And be
That's
sure to
good.
reach out, listener, because I try to put people in front of you every single week that can help you build your own passive income dreams. And the only way we can do that is if we collaborate afterwards so that we can get you to your specific goals. So I appreciate you spending your time with me. And I can't wait to see you again next week so we can talk about more passive income adventures.
Thank you. Bye bye.